Okay, good afternoon and welcome back everyone to our weekly Growth Lab series. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay, and we are going to be kicking off a new series for the month of May called Stop Chasing Trades. The goal of these series is to help you build a better process for reaching profitability because all of us, we don't lack trade ideas. What we lack is a process for how to manage those ideas into a profitable setup. So this is going to be week one, where we're going to be focusing on trading setups, focused on how to know if a trade idea is worth your attention, where we're going to be filtering, scoring, and sizing your trades. So let's go ahead and get started here because the problem is that trade ideas are everywhere, and process becomes your edge on how you sort through those trade ideas to become a better and more profitable trader. We all know this. You have trade ideas that come from just about every single angle: YouTube, social media, newsletters that you subscribe to. Your broker offers you a wealth of tools, charts, news, your watch list, your friends, just about anywhere. And the problem is that more ideas do not fix a broken process. And without a filter, more ideas are just a mental drain on how to find ideas and trades that actually matter. So, what I really want to think about is put yourself into the frame of where you currently sit today relative to your your goals with regards to trading. And I'm sure most of you here watching today, if any of you are struggling with reaching profitability, you might find yourself in a position where you're saying to yourself, I'm struggling with trading, and what I really need is to find better trade ideas and signals. How many find yourself in that particular camp where you feel like I'm at the stage where what I need are better trade ideas for trading? If you can relate to that, please type one into the chat window. Okay. I see quite a few ones in this. And this is probably, in my 18 years of working as a market strategist, working with retail and even institutional investors, this is probably one of the most common themes that I hear from traders who are struggling to reach profitability, where their view is just, I don't have the right trading strategy. I don't have the right trading signals. I need to follow someone new. I need to subscribe to a different subscription service that gives me better trade ideas or signals. And any of you that have tried multiple newsletters, strategies, people that you follow, you probably have noticed at this stage that even if you follow 5, 10, 15 different traders or strategies or newsletters, you never trade ideas and signals is never really the problem in your ability to reach profitability. What I want to reframe your thought process here is to not think about the fact and not think about this from the perspective of I don't have the right strategies, but more importantly, I need a better process for deciding which ideas deserve my capital, because not all ideas are slated equal. And it's really important that you focus on the best strategies or the best ideas that deserve your specific capital. And that's probably the biggest thing that I think most investors um, struggle with regards to trading, and that's what I want to try to fix, that specific process. So this week is just step one in a three-step process that we're going to go over during this month, and I'm calling this the setup lab, where we look at filtering and sizing your trades appropriately. Next week we're going to talk about structure, specifically picking the option strategy for your trades. And then lastly, in the third week, we'll discuss management and reviewing your trades. But today, what we want to go over is coming up with a filter setup score. And the idea is that you have so many trade ideas that come across your desk, and when markets are moving fast, there's some level of FOMO, there's some level of fatigue that you go through as you try to sort through all the different trade ideas, that by the time you actually go and execute a trade, mentally you are drained and you're not making the best investment decisions. If any of you can relate to that, please type two into the chat window if you can relate to that, because I know for many, many years, to what it felt like to struggle with reaching a level of consistency and profitability. You're constantly churning through different strategies, different indicators, different data sets, hoping that if just somehow you subscribe to a new service that has some kind of new proprietary data point or scoring mechanism, that you're going to find profitability or consistency, only to find frustration time and time again. And this comes from the fact that you have so many data points in front of you as traders today. Like I said, as a trader, there's no greater time than there is now with regards to the ability to access information that even 15 years ago, only institutional investors would typically have access to. So it's not a lack of access to data or ideas or indicators or strategies. It's the fact that we have too many of those things, that we're essentially drained, mentally speaking, from all the information overload, that it really feels impossible to make good trading decisions, which is why it's really important for your ability to reach consistency in your trading to create a filtering mechanism for every idea that comes across your desk. Now, what I'm going to show you here today is simply just a framework. It is not by any means the specific list of filters that you have to use specifically, because we're all a little different in terms of what we prefer to look at from a trading perspective. We all have different strategies, we all have different preferences. But what this gives you is a sense for a framework that you can put together that can align the things that are important to you. And I'm using the things that are important to me in this particular filtering score. And you can, I'll talk a little bit about variations that you can change depending on your specific trading needs. So the first thing I'll take a look at here is market context. So this is really taking a top-down approach and saying, what is the market telling us with regards to the direction of the market, right? And you can look at, for example, we publish a market regime every single morning before the market open to give you a sense for where the market sits. And this sits, and we have a green, yellow, and red uh, indicator for our view of the broader markets. We also publish Monday and Thursday equity research reports that give you a market regime, risk on, risk off. Those are ways that you can gauge whether the market is in a positive outlook or have a more negative sentiment. That is a good starting point. Now, you don't necessarily have to use our market regime. Maybe you subscribe to a different service that has an algorithm for determining when is a good time to be long the market, when is the time to be short the markets. You can use different, you can swap out the specific indicators or specific strategies for determining it, but the rule here is to be consistent in your application of the same rule. Does that make sense, everyone? Please type one into the chat window if that makes sense to you. So here at OptionsPlay, we'll use our market regime indicator that we publish on Mondays and Thursdays to help you gauge that risk on, risk off market. And that's how we determine in our daily plays whether we lean to be having more bullish ideas or we take on some bearish ideas for that specific day. The second thing we look at is sector context. Now, probably the most commonly used way to gauge sector context is using sector rotation data. Whether you're using, something like a sector rotation chart, or you're just simply looking at the chart of individual sectors to gauge a sense for whether that sector is strong or weak, or you can simply use the OptionsPlay tool where we have a watch list for the sector spiders. And what you can do is you can take the sector spider watch list And you can sort the sector spider watch list based on relative strength. And that is another way that you can quickly gauge which sectors are strong, which sectors are weak. So if you look at healthcare, where the strength is 3 and it's red across the board, that's telling you healthcare is a relatively weak stock, a weak sector, and it's trending lower because it's red across the board. As you can see from the chart, it's trending lower here. It's been trending lower for a couple of months now and continues to be relatively poor. That's a great way to gauge, whether you're trading with the trend or against the trend on a specific stock. Then if you look at stocks like communications or consumer discretionary with a strength of 5, but they're green, that tells you these are relatively, neutral from a strength perspective, but starting to show some signs of life from a trend perspective. And now, as you can see from the chart here, this is still very much stuck in a range, but it looks like it's potentially on the brink of breaking out to the upside. So that's one to potentially watch. And then you obviously have stocks like, or sectors like technology, that have continued to be the driver of the move here. And notice how technology generated a counter trend sell signal. That's telling me that this is very late in this particular rally, that now might not be the best time to enter this specific sector. And look at energy. Even though it's one of the strongest sectors, trends have started to turn negative just a couple of days ago. This is telling me that, this is perhaps late, very late in this overall trend, and that there's a risk of some downside. So the options play platform can give you very quick gauge for whether or not the sector is in alignment with your a specific trade idea that's coming across your desk. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. Okay, I see a lot of 2s. The third thing we look at here is relative strength and trend alignment. And that's exactly what I just showed you with the sector context, but looking at it on an individual security perspective. So looking at the options play platform here, if we look at, let's say, the Oracle trade that we put on a couple of days ago, what you're looking at is, how does the relative strength and the trend of the stock starting to form here? And what we're looking for is sort of the early entry into what could be the start of a bullish trend, because as you can see the stock here for Oracle, this stock has been on a pretty significant downtrend here since this was a roughly $325 stock back in September. This stock has essentially halved in value here over the last 9 months or so, but just in the last few months it started to bottom. It formed this double bottom here. It formed this you could call it a consolidation range for the past few months, and just recently broke out, came back to retest this level of support and started to resume that bullish trend. So you have relative strength here that's starting to build off of a base. You have the 1 month and 6 month trend that just turned positive a couple of days ago. So you have what looks like the early stages of a recovery, right? And depending on what your goals are with your trades, the relative strength and the trend indicator can give you a very clear summary of what's happening from the charts perspective to gauge whether or not you are in alignment with your goals for this specific trade. So with Oracle, we were trying to be an early break. We're trying to catch that early breakout, and the trend and relative strength indicator confirms that specific view. Now, you might not necessarily always want to catch a bottom. Maybe you just might want to just follow the trend of a stock or a sector. So look at something like consumer staples, real estate, materials. These are stocks that are, have strong trend, strong bullish trends, and strong strength, and that is just perfectly fine as well as a trend following trade. So it's a matter of finding a trend and relative strength that aligns with your specific outlook of that specific stock. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. The next thing that you generally want to look at here is what I call setup quality. And that's really just looking at the entry point relative to what your potential target is on the specific stock versus how versus the downside risk that you're taking. And generally speaking, you would have to use basic chart reading in order to get a sense for that. What you're looking for is what's your upside target? What's your entry point and what's the downside? Meaning, how far does the stock need to move against you before you would deem your trade as invalid? And what you're looking for is that risk to reward ratio. How strong is it? Is it in your favor? Is it against you? Are you already late to the game? That's kind of what you're looking at. So, just looking at an example here, we'll go back to our Oracle example for 1 second. This stock just formed its base. It's seemingly very early on in this potential breakout here. It broke out above that 170, came back to retest this level of support, starting to move higher here. Our upside target here, in the initial upside target here, is around that 230 level, but an extended target is really up to around that 280 level here to the upside, 285. So if you look at kind of how far does the stock need to reverse before I would consider myself incorrect on the specific trade. I would probably look at a pullback below that 26-day moving average where the trends have turned negative here and probably below this 161 level. If it made a new lower low, that would be my view that I'm wrong on this particular trade. So what I'm comparing is that how much upside do I have on this particular trade versus how far does the stock need to move against me before I consider myself wrong on this particular trade. And I'm looking at that risk to reward ratio. Now, this is really where there is some level of subjectivity as to what is considered a good or bad risk to reward ratio. Generally speaking, on trade setups, you want to have something at least a 2 to 1, but in good setups, many times you can find yourself 3 to 1, 4 to 1, even 5 to 1 on a risk to reward ratio is not uncommon. And this is really where you want to start depending on the type of trades that you make, whether you're more counter trend or trend following, you want to be able to gauge what is a typical risk reward ratio that you seek, what is a good one, what is a poor one, and you want to use that as a gauge to determine whether or not you satisfy this specific rule. Does that make sense? Please type 4 into the chat window if that makes sense to you. Oops. Okay, perfect. Next thing we want to take a look at here are fundamentals. And this is a bit of a minefield, when we talk about fundamentals, because fundamentals can mean just about anything. And this is really where, if you follow our equity research, which we have been doing for many years, and we publish Monday and Thursday equity research trade ideas where we give you a sense for fundamentals, we really look at fundamentals from a relatively simplistic perspective. We look at valuation relative to profitability and growth. What we're comparing is the company's valuation relative to the industry and how profitable and how fast is it growing relative to the industry. And in an ideal world, you want to buy stocks that are trading below the industry valuation, but growing faster and more profitable than the industry. Good example of this is a stock like Nvidia or Micron, trading below the industry valuation, yet seeing substantial higher growth and more profitable than its industry. That would be a good example of a stock with very strong fundamentals. And then you have stocks that have not as strong fundamental stocks that are trading at richer valuations, even though they're not growing any faster than its peers, or perhaps not any more profitable than its peers. Those are ones where the valuation are more stretched and the upside may be more limited. So you can use my template for how I view fundamentals. You can develop your own. The key here is to be consistent day in and day out in terms of how you view fundamentals, because fundamentals can, like I said, be a minefield. Same thing with technical analysis. And notice how I don't use quote unquote technical analysis in my setup, right? I'm using relative strength and trend because relative strength and trend is not a specific chart indicator. It's a actual reading of those specific indicators that are consistent from day in and day out. If you use the options play relative strength and 1 month and 6 month trend indicator, what you're essentially doing is you're using multiple indicators to gauge that trend of that stock. So you can do the same thing here for fundamentals here, in my opinion, is that instead of looking at balance sheets, cash flow statements, and all of those things and try to gauge whether or not you like a stock, look at just simply the valuation relative to its peers, and that will give you a good sense whether you have a stock that has a compelling fundamental or a average fundamental, or perhaps one that does not look favorable. And that's really how you want to gauge a stock's fundamentals relative to the rest of the market. The next thing we want to take a look at here is options liquidity. And this is fairly straightforward. And because options play will gauge every single stock with a liquidity ranking. You can type in any stock and we will tell you the liquidity ranking on a specific trade. And also, if you're looking at ideas here, we also have the liquidity ranking inside of the ideas of every single trade. You can also filter your trade ideas based on liquidity. So you can say, only show me trade ideas on very liquid options. That would be one way to avoid or automatically find trade ideas that have already met your specific criteria for options liquidity. But and again, the reason that we built these specific tools here at Options Play is to help prevent what we call decision fatigue. For many, many years before these types of tools were available, you might spend a lot of time looking at a specific stock, looking at the overall market, seeing if the sector aligns with it, looking at the relative strength, the trends, the risk to reward, looking at the fundamentals. And you do all this research and you find a stock that you really love, that you think has a really a great amount of potential here. And then you pull up the options chain and then you realize that there's not much liquidity in this specific option, or that, the bid-ask spreads are really wide and you're not sure if you're going to be able to get filled, or just the risk reward of that option that you wanted to trade is incredibly poor. And what happens is that by the time you actually find an idea that meets all your requirements and is liquid from an options perspective and has that options risk reward that's favorable, you're mentally fatigued. You're fatigued and you make bad trading decisions because you're kind of just at that point desperate to find an idea that actually meets most of your requirements. And a lot of times at this stage, if you don't quite get the optimal setup, you still trade that because you're too exhausted to try to start from square one again and and find a new stock and see if it aligns with all the other indicators. If any of you can relate to that, please type one into the chat window, because I know I've been there. I know that, I'm on TV. I'm on all these different shows where my job is to come up with an idea, and there are some days where I just cannot find a good idea. And by the time I actually select one, I'm not particularly that happy with the one that I've selected because I'm just emotionally drained. And I know that if I'm in that particular that mindset, I know many of you are as well. And that's why we built these tools to try to help you screen for these things ahead of time. Screen for options liquidity, screen for the options play score, screen for relative strength, the market context, sector context, all of these things as much as possible for you so that by the time you find an idea, most of those things have already been pre-screened for you. So you only have to validate one or two things on a specific trade. And then if you validate those things, you can go ahead and place that trade. So our goal here at Options Play is to try to bring as much automation to this filtering process to you as possible so that you can go through it as quickly as possible and not drain that mental capital that is so precious, so that when you make a trade, you're doing it with a clear mind and not from point of exhaustion and frustration, which is where I think a lot of traders find themselves in. Okay. So options liquidity is a really easy one. Options risk to reward is also a really easy one because you can type in any trade on options play and we have an options play score. The options play score helps you gauge the risk to reward and expected value of that option, whether you're looking at a debit spread, a credit spread, or you just simply want to eyeball it and get a sense for your risk to reward. That will give you a good sense for whether the trade is in your favor or not. And once you are familiar with specific strategies, the risk to reward, meaning what is a good risk to reward, what is a poor risk to reward, those are things that become relatively second nature to determine. So, for example, if I'm selling a credit spread, I don't want to risk more than two times what I'm collecting in terms of a credit, but many times I can find myself placing trades where I'm actually risking no more than 1.5 times the credit that I'm receiving. So that's kind of how I'm gauging the risk reward of the options trade. And lastly, we look at event risk, earnings, economic news, anything that might have a binary event that can potentially drive volatility in that specific stock. Now, here's the thing about event risk. Different investors will see that as a positive or a negative. Some of you like that event risk. You see that event risk as an opportunity to for the stock to move in the direction you expect it to, especially if you think that the move is fairly sizable. In order for that stock to make a big move, you need a catalyst in order for that to happen. So some of you may view that as a positive thing. Now, if let's say you are selling options or selling an iron condor, maybe the event risk is not a good thing for you. So that is one that is going to depend on your strategy or depend on your outlook of the individual stock as to whether having earnings is a positive or a negative for you. And you have to set that up appropriately for yourself. But the goal here of this is to help you start thinking about a framework that you can use for your specific type of trading, for your specific strategy, for your specific way of looking at the markets, and start building a repeatable process that you can quickly tick off before you place every single trade that's going to help you gauge how strong or how aligned are you on a specific idea with your ideal setup. And each filter is a tick, and the score at the end, what that determines is actually whether or not you trade this specific trade. And more importantly, it can also determine the sizing of your specific trade. And sizing is arguably one of the most important conversations that most traders don't really have a good plan for with regard to their trading, yet it has an outsized influence on your performance as a trader. So when we talk about sizing here, you generally want to think about the number of ticks that you get to determine whether or not you trade it. So for example, if you're using an 8 tick system like I'm proposing here, if you're having a trade that only passes somewhere between 0 to 5 ticks, that's probably one that you might want to just pass and avoid and maybe keep it on a watch list for now. Maybe in a couple of days, things turn back around where the trend starts to work in your favor, or the sector starts moving in the direction in your favor. Then it moves up, and then you can potentially start entering the trade. But until that happens, you want to have a disciplined approach to avoiding bad ideas or ideas that are not aligned fully with your overall strategy. And then you have stocks that have more moderate alignment with your specific outlook or the way that you like to trade. And those are ones where you want to have, some exposure in, right? Maybe start off with where you're risking 1% of your account on a trade. And if it works in your favor, you ramp it up to 2%, which might be your typical size on a trade. And this is under the assumption that you're risking 2% of your total account value on a single trade as a general rule of thumb. And that's always from my perspective, a good place to start from a risk management perspective. And then lastly, on the few opportunities where you have alignment across the board, across all the different segments that are important to you as a trader, those should be relatively rare. And those are the ones that you start with maybe 2%. So you start with the full size position because you have alignment across all of those different segments. But then this is really where you have the opportunity to size up very quickly. And that's really what differentiates trades that are highly aligned with what you're looking for, that also start working in your favor, is that you ramp up sizing. You ramp up sizing in those trades only because those are the types of trades. It could be just a few trades a year, to be perfectly honest, but those are the trades that sometimes produce the vast majority of your outperformance or trade performance for that specific year. And that's really kind of the reality that I also want to impart you with here today, because a lot of people think that, oh, this sounds like a great system. I'm going to implement this. And if I just implement this, I'm going to start making, consistent profits. I just want to be realistic with regards to, whether when you use a system like this, that I'm suggesting, you might see your win rates go from something like 50% today, where you're not using a filtering system today, to maybe, 55, 57% when you start using a filtering system. So you have to still be aware of what the reality of trading looks like, meaning even the best setups, when you're the setups that maybe only come a handful of times a year, those setups might only give you maybe a 60% win rate. So you really have to make sure that you are sizing these appropriately for the expected increase in win rates, because you're going to be having substantially lower trading opportunities in those trades that you have a lot of confidence. But those trades that have a lot of confidence, those are the ones that you want to size up very quickly. And those are the fewest trade ideas that you want to size up, up to maybe even 5% of your total portfolio value on that one trade. But the key here is that you still never want to start something with a high amount of conviction with more than your original max loss, which is 2% of your account value. It's only that you enter a trade with 2%, and if the trade starts to work in your favor, then you ramp up to that 5% range. I don't ever want you to think that, okay, something's met 8 of my ticks, I'm going to start with a 5% trade. You don't, just because something has met 8 out of 8 alignments does not mean that you should enter with a bigger size than you normally do. You still have to enter with the normal size, and only if the trade starts to work in your favor. And many times, trades that are incredibly favorable may work immediately, meaning once you have the market, the sector, the trend, the risk reward setup that's working in your favor, those trades might start working out, the day that you enter them. And if you within 2 3 days the stock is moving in your favor, you can size up quickly. But you always want to start off with the core position before you size up in that specific name. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. So today what we're going to look at is 3 trades that meet different specific requirements to give us a sense for how we make our decisions. We're going to look at Oracle, which is a trade that we put out a couple of days ago. We're going to look at Estee Lauder, which is another trade that we recently just put out here, I believe yesterday. And then we'll look at Amazon, which is a trade that I was looking at earlier this week that we ended up passing on because it didn't meet enough criterias. So the first one to take a look at here is Oracle. So if you look at this Oracle trade, this was the trade from a couple of days ago. If you look at kind of the market context, we've been yellow in the market context that we recently just went green this particular week. But if you look at the equity research that we put out every single week, we've been in a very clear risk on environment here for the last, call it, 4 weeks or so. That risk on environment has been relatively narrow within the semiconductor tech industry, but nonetheless, we have been in that risk on environment. So that provides us with checks 1 and checks 2, the market context and Oracle sits within the technology sector, which has been the one sector that has been leading this market higher. Then we look at relative strength and trend alignment. So, like I said before, Oracle has been in this clear downtrend here, but over the last couple of months have been forming this base here and recently broke out, came back to retest it, and trends turned positive here just a few days ago. So we have all of the relative strength building and the trend quality that's continuing to improve here for Oracle that gives us kind of that technical view that relative strength and trend alignment is aligning with kind of the early breakout type trades that we're looking for in this Oracle trade. Then we look at setup quality. You know, when we entered this trade a couple of days ago, Oracle was trading at around 180. And I had told you that if it got down below 160, that would be my invalidation level. But our upside target here for Oracle is our initial upside target is 210, but our extended target here is 280. So we really see a lot of upside potential relative to the downside. And that's really where the risk to reward, also the setup quality, was incredibly strong. Oracle fundamentals look quite strong here as well because the stock has pulled back so much in the last 9 months or so. It's trading around 21 times forward earnings, much cheaper than most of its peers in the cloud computing space. Incredibly strong net margins and free cash flow. They're spending a lot, but they're generating a good amount of free cash flow to offset that spending. So you have strong growth, profitable stock trading at compelling valuations. So you got another tick from a fundamental perspective. Options liquidity on Oracle is incredibly liquid. Options risk to reward on the trade that we entered a couple of days ago was also very strong. We bought a debit spread, the 810 210 debit spread for about $10. That gives us a 2-to-1 risk to reward ratio on that specific trade. And the only thing that didn't give us that final tick on Oracle is the fact that earnings is coming up here in 34 days, and you can view that as either a good or a bad thing here. But from my perspective, I'll put that as a negative just for 1 second. I generally think of earnings as actually a positive here. So depending on which way you can go, this is either a 7 or 8 in terms of a score on this particular trade. It really has everything that we're looking for in a ideal setup for an early breakout. And that's exactly the type of trade that Oracle was slated at in this particular trade. So this is one where we would typically start off with 2% of our trade. And as you can see, in just the last couple of days, when we entered this trade, it was $180. It's now up to $195. So we've already cleared that we've already made that new high that we're looking for. Now, if let's say over the next couple of days, it can pull back here and make a new relative low, a higher low, that would give us the conviction of adding more positions in this particular trade. And this is something that we've been highlighting in our daily plays. When a trade has worked in our favor and is now generating a new bullish signal, that's really where we start adding more exposure to that position. An example of that here was just a couple of days ago, we added Oracle is actually a trade that we added from 420. So on 420, we initially added that position here in Oracle. When it was at 175. We sold the 170, 155 put vertical here. And now that the stock has kind of made that new low and came back and generated that new buy signal, that's when we started adding to this position here. So Oracle is already a position that we added. And I think that if we get a further pullback here, we have another opportunity to add. So this is a prime example where if you take a trade that has the workings that are working in your favor, we initially took a small position because that was more speculative in nature at the time. We weren't, the trends weren't as clear, even though the market and sector scores were there, the setup quality was there, but the relative strength and the trend of that stock wasn't so clear just yet. It's become a lot more clear in the last few days, which is why we've added to it. And I think that over the next couple of weeks, if this starts to pull back here, we have another opportunity to add even further. And that's how we ramp up from initially what could be a 1% risk of our trade up to that 5% rule in a stock like Oracle. And we call these out when we do these on our on our daily plays. We also recently added to a position here in Teradyne, which is one of the semiconductor stocks. We had a position here in Teradyne back here on April 2nd. We entered that position here in Teradyne when it was trading at 312. And then a couple of days ago, we added to that position when it generated a new signal on May 1st. When Teradyne was trading at 343, we essentially added more to that specific position. So when trades work in your favor and come back to generate a new trading signal, you can add more exposure to that trade. So you keep that original trade and you add more exposure. And when stocks are working in your favor and they generate a new buy signal and things have even improved from when you first enter that, that is where you want to scale up and add exposure. That is not where you want to shy away and pull back from those specific opportunities. Does that make sense, everyone? Please type one into the chat window if that makes sense to you. Perfect. So let's take a look at Estee Lauder, which was a trade that we put out, I think, just yesterday. Now, Estee Lauder as a trade was, just a little bit more speculative in nature than Oracle because we had the market context, but we didn't have the sector context because the consumer packaged goods industry, the consumer discretionary industry so far has not quite given us the upside that we're really looking for. Remember, if we go back to our watch list here of the sector spiders, consumer discretionary, as you can see, has a strength of 5, meaning it's kind of on par with the market. It's not outperforming yet. It hasn't kind of given us the strength here over the last few weeks. The trend quality has improved, but it hasn't broken out yet, right? It's the trends have turned bullish, but it's kind of still bullish, but trading sideways here. We really want to see a breakout here above, call it 122 or so, to say, hey, things are starting to look more constructive. And we really want to see a breakout above 125 to get much more bullish here on consumers. But there are some early signs of recovery, and that's why we're taking a small position here in Estee Lauder. You got the relative strength and trend alignment here for Estee Lauder because it has the same setup as we saw here as Oracle. So if you see Oracle, if you look at kind of the chart setup here, you've got this bottoming formation that formed here around that $80 level here and just recently broke out here. So the upside is potentially strong here, but I will say the setup quality looks incredibly favorable because our upside is in this 115 area versus if this thing pulled back to just below 80, that would be our area where we would invalidate this trade. So the setup quality looks quite strong here, but the fundamentals are not particularly strong. Estee Lauder trades at a valuation that's nearly double the industry, even though growth expectations are maybe a little bit higher, but profitable. It's actually less profitable than most of its peers. So from a valuation perspective, it is a little stretch. We do think that the market is being a little bit pessimistic on this particular stock from a fundamental perspective. That's why we are taking a risk in this particular trade. Options liquidity on Estee Lauder is not as strong as a stock like Oracle, so that's why we have it doesn't give us the tick on fundamentals or options liquidity. The options risk reward in the trade that we found was quite favorable, which is why we like it. And in this particular case, Estee Lauder does not have earnings coming up until August. So there's event risk here. I'm putting that as a check mark because there's no earnings risk in this particular case. So here we've got 1, 2, 3, 4, 5, 6. Five out of 8. So this is really a potentially a moderate or a pass, and this is why we would potentially start a position like this with only maybe 1% risk of our portfolio. We entered this trade a couple of days ago when Estee Lauder was at 82.85, and so far it looks like the trade is starting to work out here. We're at about 85 here. It's starting to move a little bit higher here. In the next couple of days, if we get another buy signal here in Estee Lauder, this is the type of trade where we might upgrade this to a 2% position in Estee Lauder. And then lastly, I'll walk you through the Amazon trade. Amazon, we've been looking at Amazon, just alongside with all of the kind of AI and cloud providers here. Amazon obviously having alignment here on the market and sector, but from a relative strength and trend perspective, you can see we recently generated this counter trend sell signal. And this is just telling me that when a stock runs from 200 to 270 in about a month's time, that is statistically speaking stretched, and that chasing this move here to the upside is statistically unfavorable. That's what this is telling me. It's not necessarily saying that you should be bearish on it, but it's a warning signal for what is a clearly bullish trend that now is maybe not the best time to be seeking new long positions in this particular stock. So if you look at that, the setup quality also isn't particularly strong because, how far does this stock need to pull back before I would say, hey, you know what, I'm wrong on this particular trade? I'd probably need a pullback here at least below 250, but probably even going further down here before I would say this is wrong versus how much upside is there in Amazon? It's hard to say because you're at new all-time highs. So the setup quality is just not as clean here for Amazon. The fundamentals are not particularly strong here for Amazon. It's expensive. It's 33 times forward earnings, and profitability is only about 12% net profit margins because you have to remember 60 plus percent of their revenue, or I'm sorry, 80% of their revenue comes from retail. AWS still only accounts for about 20% of their total revenue. So that's really where the fundamentals aren't there. The options liquidity certainly is there. The options risk to reward on Amazon also wasn't particularly strong here when I was looking at this. Selling a put spread, I'm collecting less than 1/3 of the vertical width here. So the options risk to reward ratio wasn't quite there. And there's also no earnings catalyst coming up here. So uh, it just didn't align with enough things, in my opinion, to take that risk here for Amazon. So the reason that I'm showing you these examples is to just walk you through some trade ideas that we walked through this particular week and how we looked at these specific trades from a process perspective, because that process helps remove that mental drain, that decision that you have to make. Do I take this trade? Do I not take this trade? And you're kind of weighing up all these different things in your head. And you're trying to think through, what do the fundamentals look like? What does this look like? Versus if you have a check sheet like this and you just go tick, 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 that's going to give you a much more um, uh, easier decision-making process that's going to remove that mental fatigue that you go through when you're trying to validate a trade idea, when you're trying to think about what should I trade today. If you have 4 or 5 trade ideas coming across your desk, making sure that you come across, you take, those specific trade ideas through a process like this and look at what the scores of each one, that's going to help make your decision as far as which ones to trade and more importantly, how much size to trade on each one much, much clearer. And by removing that mental fatigue, you're going to come to every single trader with a much clearer mindset, and you're going to make much better decisions from your trading. Because, when I look at traders who struggle, it's not their indicators, it's not their strategies, it's not, uh, what data points they're looking at that differentiates successful traders from traders who struggle. It's actually how they approach each trade from a decision-making process and how clear-minded they are when they make their decisions. Because a lot of times we know what the right thing to do is. We lack the emotional ability to sometimes follow through with what we know is the right thing to do. And that's why we hold on to losses longer than we should. That's why we take profits too early, because emotionally we don't want to deal with the pain of crystallizing a loss or dealing with a win that turns back into a loss. We find as human beings, we find that incredibly painful to have a winning trade that we hold on to for too long that ends up being a loser. So we take profits too early, even though we know that's counter to being a profitable trader. So what what I'm trying to help you do is to build a better process to make better decisions so that you are making decisions from a clear headed perspective, and that is how you become a profitable trader in the long run. This is the first step in a multi-step series, but today I want to start you off with coming up with as a score that's going to help you size your specific trades. So this week, what I want you to do is I want you to pick one trade idea. You can pick it from any source, from our Monday playbook, from our watch list, from our trade ideas that we send out every single day, or just a chart that you're watching, whatever trade idea. Go through this at least once. Make it something that you do this particular week, and also think through this filter list. See if it makes sense for you. You might find that some things may not make sense for you. Maybe you don't look at fundamentals, or you don't feel particularly strong on fundamentals as a way to screen for your ideas. Maybe you prefer to look at seasonality. So replace one of these with something that you feel better suits your specific strategy or the way that you trade. There's nothing wrong with that. So take the time to look through this list, see if you need to make any modifications, and pick one trade and go through it. Score it on, whatever number of filters that you have, and then start deciding on a starting size for that trade based on how many ticks that you have on this particular trade. And what I want you to do is I want you to bring this to us next week to our structure lab, where we're going to be looking at option strategies, specifically picking the right strategy, picking the right expiration date, picking the right strike price, in helping you take the next step in your decision-making process for these specific trades. Okay. So this week, what we did was we covered, the 8 filters and kind of tallying those ticks to determine your size. Next week, we're going to talk about the strategy, choosing expiration dates and strike prices, and making sure you define that risk to reward ratio. And Monday, we are going to be, doing our market playbook here every Monday morning, where you're going to get fresh ideas. So if you want some fresh ideas to run through the scoring mechanism, we will be doing that on Monday morning, where I'll giving you an overview of the broader markets, where we currently stand, and some trade ideas to walk away with. And you can take those trade ideas and score it through this mechanism to help you gauge which ones you might want to trade for your portfolio. And last thing, 3 things to take away from you today. Remember, a trade idea is not a trade plan. A trade idea are just ideas, and there are millions of them out there. Don't let them overwhelm you. Take a process to filter those ideas into a decision as to whether or not you trade them, and more importantly, what size you trade them with. I've given you 8 filters. You can think through those filters if it makes sense for you, but come up with a filtering system that makes sense for you and size your trades at least once this week, if not for all your trades. And then size up only when the evidence earns it. There's nothing wrong with sizing up a trade when things are in alignment, but make sure that you have a clear process for determining which ones are the trades that you size up on, because that is the process for how traders outperform in this particular market. You have to make sure you keep your losers small, and then when you have the opportunity to hit a home run, you take those opportunities. But you need to be disciplined in when you take those home run approaches, when you swing for those home runs, and this process will help you define that. So if you are watching this recording and you are seeing OptionsPlay for the first time, you can sign up for the platform that I showed you today at new.optionsplay.com/registration, or point your phone to that QR code on your screen. And that's going to give you access to our daily trade ideas, our strategy screener and sizing tools, these live coaching sessions that go on every single Monday and Thursday, and an OptionsPlay score to help you score every single trade, and our trade checklist that will help automate some of the steps that I'm showing you during today's session. With that, that covers what I wanted to share with you here today. Okay, good afternoon and welcome back everyone to our second part of our Stop Chasing Trades series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. Last week we covered how to score different ideas that come across your desk to understand which ones are worth your time and capital, specifically which ones you might want to size up on, which ones you want to start with a small base position and then potentially size up on, and which ones you might want to start with just your base position. And today, what we're going to do is we're going to take that to the next step, which is once you've scored an idea, determine that it's worth your time and capital to get exposure to a specific idea. How do you want to structure that from an options trading perspective? That is what we're going to go over during today's session. Now, if you missed last week's session, I highly recommend that you go back and watch the setup lab from week 1, where we went over an 8-step criteria for helping you score various ideas that come across your desk so that you don't find yourself chasing trades, you don't find yourself evaluating various things across various strategies, that you have a consistent application of determining which strategies are worth your time and efforts. And then today we're going to take that to the next step and leverage that into your into the specific strategies that you would use to structure that from an options trading perspective to gain the maximum profit potential from a trade idea. Now, if you're new to OptionsPlay, I highly recommend that you take a look at the link here on your screen, new.optionsplay.com. I will copy this and post it into the chat window. You can also point your phone to the QR code on your screen. That will get you access to this link here on your screen. Whoops. That will get you access to this link here on your screen, and that will allow you to sign up for OptionsPlay, which will give you access to everything that I'm going to show you during today's session. My screen is paused. You are right. Give me 1 second. So the QR code here is on your screen, and I just posted the link into the chat window here as well, so that you can follow us along if you are new to OptionsPlay and have access to the tools that I'll be showing you during today's session. I'll leave that up there for 1 more second. For those of you that are new here, my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. I have been working with retail and institutional investors for 18 years now, helping them understand market structure, understand how best practices for evaluating ideas and trading various asset classes, starting from futures to currencies to Forex, to equities and options, across all of those, helping investors better understand how to reach profitability in their trading. So last week, we learned about this 8-filter setup score, where we looked at the market, the sector, relative strength and trend, the risk to reward of the underlying equity that you're evaluating, the fundamentals, options liquidity, options risk to reward, and event risk, and using that to gauge how strong of an idea are the various ideas that come across your desk, since we all are bombarded all day long with various ideas, to have a filter mechanism to understand which of those ideas are worth your time and capital. And once you've determined a stock or a specific idea is worth your time to allocate some of your hard-earned capital to, what we want to talk through today is the same idea can be expressed many different ways when it comes to options. And you can turn a good idea or a great idea into a fantastic trade, or a great idea into a suboptimal trade, depending on the trade structure you choose. So that's why what we're here today is during our structure lab to pick the strategy. And then next time we will be looking at how to manage those positions. So last week we talked about filtering and sizing. Today we're talking about picking the strategy, and then next time we'll be reviewing how to manage each position. Just a little bit of housekeeping here. I am off next week, so management and review lab will be the following week on May
28th. We will send you an email reminder of that. So, and many of you that are watching here today are probably familiar, any of you that have ever traded options are familiar with the concept where you got the thesis right, but you ended up with the wrong structure. And it happens a lot more often than you think. And ultimately because you can't tell the future. There is no way to always have the most optimal strategy. But if you have a process for evaluating each particular setup, the goal is to have a higher probability of success of picking the right structure for the thesis that you have on the underlying security. And like I said, any of you that have traded for any period of time can relate to at least one, if not all three of these scenarios. The first one is the wrong magnitude, where, for example, you used a short premium trade, short put vertical, and the stock just ripped higher. I have a couple of examples to show you here today that we have recently done in the past month where essentially we evaluated the magnitude of the expected move incorrectly and chose a structure that was suboptimal for the specific move, where we sold premium expecting a modest move and then the stock ran significantly higher than expected. The other one is the wrong time frame, where the theta decay on the option essentially ate away at the potential gains of the trade. You bought an expiration that was too short. The move ended up coming a few weeks later beyond when your expiration date was, and the long premium trade, the long call or long put, essentially expired worthless. Or this is not as common, but it does certainly happen where you pay for the IV and you essentially got the implied volatility expectation incorrect, where you were long premium when the implied volatility was rich. When the move came, the implied volatility crush that comes along with that big move ate away into your gains. If you could relate to any one of these, just one out of these three, just type one into the chat window if you can relate to this as a trader, where you essentially had a fantastic thesis, but essentially traded the incorrect structure or a suboptimal structure for the thesis that you had. So what we're going to discuss here today is sort of a 4-question filter that's going to help you better, that's going to have a more disciplined approach to selecting a strategy that fits your thesis. What we're going to evaluate is direction and conviction. So this is simply looking at the trade idea itself. What is your directional view? What is your conviction? From my perspective, direction and conviction usually come from a combination of where the idea came from, meaning what generated the idea, as well as, what the market consensus sort of is. When the market has, when there's a general consensus that all align, the conviction, generally speaking, isn't as strong sometimes as when the consensus is not as strong. What do I mean by that? Let's say you're bullish on a stock that a lot of analysts are bearish on. That's where the consensus is not particularly strong. Your views are against the consensus. Many times, those are the ones where you have some of the biggest moves because you're essentially saying that you think the market has got it wrong. And if the market proves your view to be correct, the changes of that, the moves in that underlying stock tends to be far more dramatic when everyone sort of has got it wrong versus if everyone believes that the stock is bullish and you're bullish on that specific stock, chances are the size of potential move tends to be a little bit smaller. So direction and conviction is the first thing you want to take a look at. The second thing is time frame. This is many times taking a look at also what generated the trade idea? Is it a technical based scan? Is it a technical analysis indicator that triggered a specific strategy? Many of you use technical analysis in your decision making process. And if you're using technical indicators, you should be familiar with the strategy that generated the signal and understand out of that signal, what are the general time frames that those signals will resolve themselves within. If it's more of a fundamental trade, you need to have a better understanding of, generally speaking, how long it takes for fundamentals to play out. If it's a statistical type strategy, if it's we all have different strategies, and it's a matter of matching the time frame to the the signal, if you will, that was generated from that specific strategy. The next thing we want to take a look at here is volatility. What is the option market implying as to the future volatility of this specific stock? Is it relatively cheap? Is it relatively rich? Or is it a fair in terms of what the options market are implying? Now, we'll talk about this here in a little bit, but remember that volatility is a mean reverting statistic, meaning if the market is implying a rich expected implied volatility, then that is really where you're going to see that's where the it favors I guess what I'm trying to say is that implied volatility many times is counterintuitive. When the market is implying a very volatile future, instead of expecting that actually to happen, many times we actually bet on the opposite because, like I said, implied volatility is a mean reverting statistic. So when the market believes that the future volatility is very high, it's actually more likely that that will actually revert back to a more fair value, and vice versa. If the market is implying a very calm future, that tends to be an opportunity to be a buyer of volatility and expect things to be more volatile in the future. And then lastly, magnitude. Is the expected move relatively big or is it relatively modest? And there's a combination of technical factors that we typically would look at for that, as well as taking a look at the earnings calendar. Are there earnings coming up? If there are, what are the expected timelines for that to happen? Is it going to be within the expiration date or not? These are some of the things that we always look for as an options trader, is to look at things like support and resistance levels, as well as the earnings calendar. Now, someone here in the chat said IV figuring out IV is easy, but time frame is hard. I'd say time frame probably, in my opinion, is not as hard as the magnitude side. I think most people actually struggle more with the magnitude, meaning how do I know if the stock's going to make a big move or a small move versus time frame? Because time frame tends to be fairly structured with every single strategy. For example, if let's say you are a technical trader, you have to look at what technical indicator you're using to determine your signal, right? Every technical indicator has a look back period, and that look back period gives you somewhat of a timeline as to how far in the future would you expect the move to happen within to determine that. If you're trading a breakout or a breakdown, chances are those moves happen, if they are a valid signal, they tend to happen fairly quickly. They don't usually take 3 months for a breakout to get confirmed. Breakouts will usually confirm within a couple of weeks at most. So I tend to find time frames shouldn't be so big of a struggle. You can always take a slightly more conservative approach to your time frame. So if you think on average it takes 3 weeks, use a 5 week time frame. If you think on average it takes 1 week, use a 2 week time frame. Give yourself a little bit of room on the time frame side. And if you constantly find yourself picking the wrong time frames, then that's also a relatively easy thing to correct. If you always find yourself, seemingly a week or two short of that expert of the actual move, then, adjust your time frames to, maybe 3, 4 weeks out than what you normally would trade. So time frame I tend to find is something that's relatively consistent that you sort of dial in once and you can kind of consistently use that time frame versus magnitude is probably the one that's most traders will struggle a little bit sometimes with is, how do I know I can't tell the future. How do I know if the stock's going to make a small move or a big move? So this is really what I want to spend a little bit of time on to think through three inputs that can help you better understand whether the expected move is going to be more of a big one or a modest one. So the first one you want to take a look at here is distance to target. Now, what we typically use for that is to use support or the resistance levels to determine, just what could be a potential target price of this specific stock. And if the target price is meaningfully away from where the stock is trading today, then you have the basis for what could be a big move. If it's nearby, then you might be more inclined to believe that there is going to, at least in the short run, be more of a modest move. So, when you're using the options play platform, I'll use C as an example just because it's fresh in my mind as a trade idea from a couple of days ago. What you can do is you can use the options play platform and you can actually build these support and resistance level on your platform. And these are the support and resistance levels that you see here at the bottom of your screen. If you click on the support and resistance levels buttons on your chart, it will actually draw those support and resistance levels on your specific chart, right? So as you can see here, we have a major support here at 77, a major resistance here at 198. We have a minor resistance that just started, just started developing in the last couple of days in this 110 area here. That would be, I'm sorry, the 100 area here. So this would be kind of where you would be looking at short term. I'm probably targeting 100. If we can get back of 100, the upside target here is pretty substantial here. So that's something that you can start taking a look at. And prior to a couple of days ago, the upside target here was that $200 level versus the downside target here was that 70 what was it, 70 $77 level here, right? So you can have you can use these support and resistance levels that are automatically drawn here on your chart to help you better understand the potential magnitude or the potential size of the move. Last week we talked a little bit about risk to reward. These are one of the things that you can do to evaluate that risk to reward within the options play platform. So distance to target is the first thing, and you want to just get a sense for if you have a bullish view, what's the next resistance level? How far away is that? That's a good starting point to help you determine whether you expect a modest or big move. The second thing you want to take a look at here is implied volatility. Is the market implying a big move or a calm one? And this is the one that is counterintuitive because if the market is sort of implying a big one, um, it actually, from a statistical perspective, favors betting that there will be more calm, and vice versa. If the market is saying is pricing in a calm future, it's actually more favorable to bet the opposite and say that we think that there's going to be a more volatile future, again, because volatility is mean reverting, right? Meaning if it's high, it's more likely that it's going to revert back to the average. And if it's below average, it's more likely it's going to rise sometime in the future back towards the average. So implied volatility is a contrarian indicator, if you will. And then last thing we take a look at here is the earnings calendar. And this is really important as a trader is looking at that earnings calendar. So, we always have the earnings check. We always have the earnings date on the top of your screen for any security. Any stock you type in will show you what the next earnings date is. And then whenever you're placing a trade, we also have an earnings date check in our strategy checklist. So the earnings date check will also check the specific expiration date. So right now I'm trading a July expiration date and the next earnings is August. But let's say I was to structure this. Let's say I decided that I'm going to buy a September call option, for example. When I go to click trade, it will flag the fact that there's an earnings coming up before the expiration date of my specific trade. So you can always either check the earnings date at the top of your screen, or when you're placing a trade, make sure that you use the strategy checklist, which will always evaluate your specific expiration date against that earnings date. So those are three factors that we typically look at to determine whether or not we believe the stock's going to be a big one or a modest one. Um, and based on that, what you're going to do is you're going to select from 5 core strategies. Now, there are obviously more option strategies than this, but these one, two, three, four, five, six, seven strategies will likely form the basis of the vast majority of the trades that you will make when you have a directional thesis on an individual stock or ETF. A long call or a long put, that's the outright bullish or bearish trades. The short put, that's more of a neutral to bullish trade. A debit spread, which is a strong directional trade, and a credit spread, which is a modest directional trade. And based on the things that we've discussed up until now, this is kind of how you would typically determine which one of these strategies might be most suited for you. So whether if you have a very bullish view, meaning an outright bullish or bearish view, that's where a long call or a long put is going to be the a suitable potential trade. And the general rule of thumb for those types of trades is we usually start our trades with about a 60-day expiration, and we usually start our research with buying slightly in the money calls or puts as a starting point. Now, for all of these strategy defaults that I'm showing you here today, the OptionsPlay Strategy Center applies these defaults automatically. So you don't have to memorize them. I have this on this page for those of you that want to learn, but the platform actually applies these defaults for you automatically. If you're looking at short puts, where you have a more neutral to bullish view, these are stocks that are maybe starting to form a base. You feel that they're near a bottom, and these are buying opportunities for these particular stocks. Selling that put sometimes is a fantastic way as a stock acquisition strategy to do so with a discount on that stock purchase compared to a limit order. And selling a 30-day 40 delta strike price is usually a starting point for us there. Now, if you do have that strong directional view, sometimes a long call, a long put is a good starting point. But for a more targeted view, right? So meaning in this C example, where the upside potential is really sizable. Some of the other ones that where you have the upside opportunity, the upside may be a little bit more limited, and that's really where you could potentially use a debit spread, using a 60-day slightly in the money call option. So what you're doing is you're essentially still buying, you're still buying the 60-day at the money, slightly in the money call option, but you're selling a 20 delta call against that. So you're essentially combining two strategies together And that's going to reduce your overall risk compared to the long call. It's going to reduce the amount of implied volatility that you're trading. So, that volatility crush that we're referring to, this will negate a bit of that. Um, and it reduces your overall risk on the trade sometimes by as much as 25 to 30%. And 25 to 30% is a huge savings from a risk perspective that will go a long way to generate a much higher return on investment when you do get that directional view correct. Because ultimately, when you have a bullish view on a stock, chances are you don't think the stock's going to go from 100 to 500 in a week, even though that's very much what we have seen in the last few weeks. Stocks that were $300 that all of a sudden are $700 a month later. But the markets that we're in right now are quite atypical. And then lastly, when you have perhaps more of a modest directional view, similar to a scenario where you might be selling a put option. But the thing about selling puts is that one, it requires a fair amount of capital to do so. It also has a significant amount of risk, meaning if the stock were to fall to zero after you sold a put, you would have essentially the same risk as owning 100 shares of the stock minus the premium that you collected on the short put. And not everyone wants to take on that amount of risk or have that amount of capital sitting there to deploy to a short put. And that's really where credit spreads come into play. Credit spreads give you a bit of the best of both worlds. It gives you the ability to sell a put option or sell a call option, but do so in a way with limited risk, limited margin requirements. Usually, the margin requirements to sell a credit spread is somewhere in the 5 to 10% range compared to a short put or a short call. And and what it does is it gives you a very similar risk profile to being short a call or a put, but doing so with that limited risk. And we usually use a 45-day credit spread. We'll use typically a pretty aggressive credit spread. We'll sell essentially the at the money call or put, and then buy a 25 delta call or put against that, where our goal is to collect about 33% of the vertical width. Like I said, you don't have to memorize any of these specific starting points of this specific strategy because our platform already applies these as your default. So, for example, if you are looking at a specific stock, where we're looking at Biogen earlier today, because it recently just started to break out here above. It looks like it's already pulled back here today. This was initially breaking out above 200 just yesterday. It's pulled back here along with a lot of other stocks here today. Let's take a look at some other stocks that recently broke out. Apple recently broke out here. It did generate this counter trend sell signal, which is just telling us that the move in this particular stock over the last month and a half is quite overextended, that you are more likely to see some level of a consolidation or a pullback, and that right now is not the best time to buy this stock, hoping that it's going to continue this momentum here to the upside, that you're more likely to see somewhat of a stall or a pullback here. So let's take a look at some other stocks. I'm trying to find you a good stock that we can potentially take a look at. Let's look at Nvidia. Nvidia, it has continued to move higher here. As you can see, Nvidia just broke out to a new all-time high 4 days ago, right? So the 215 highs, the 215 highs were the all-time highs, and the stock has just continued to take off since then. So this is a relatively fresh buy signal that was generated just 3 days ago around that 220 level. We're trading at 234. So, whether you're looking at buying that call option, buying that debit spread, or looking at selling that credit spread, all of the strategy defaults that I just showed you on that slide are automatically applied here for you so that you don't have to memorize how to, these specific defaults, right? You just have to focus on evaluating the security, evaluating the magnitude, evaluating the expectation of the specific move. So look at Nvidia here, right? The stock recently just broke out here above that move. Keep in mind that the stock has already extended itself from $160 stock back here in March to now $234 stock here, just a couple of months later. So you have to ask yourself, how much more upside is there in Nvidia? This is also probably one of the most crowded trades, one of the most crowded sectors at the moment, meaning consensus is nearly 100% bullish in this particular sector. In those specific types of sectors, the expected move tends to be more modest. There is earnings coming up here in 6 days. That could be one major catalyst that does move this particular stock. But IV rank is also relatively high. So expectations are very high at the moment. So from when I look at this, everything on balance, my view is that, the upside is probably more modest than it is substantial here to the upside, given where the stock has moved already so far, what the options market is implying, but also taking into account the earnings that's coming up in 6 days' time, I would probably be more inclined to be an option seller in this particular environment, looking at maybe selling that put spread. This because IV rank is 75% out of 100, so this is relatively expensive. So that's why I'm choosing the high implied volatility strategies that are suitable for, these types of environments, which is, selling things like a put spread because I'm bullish on this particular stock and not selling the call spread because that would be if I was bearish on this specific name. And then you can also sell the straddle or the strangle if you're more neutral on this specific name. So, the OptionsPlay platform structures these trades automatically for you so that you don't have to pull up an options chain and remember, oh, for long calls, I should start around 60 days out. I want to use strike prices that are slightly in the money. This already does all of that work for you. So as you can see, this is chosen for you that July 230 call, which is 64 days from expiration, slightly in the money, and it will give you that starting point. It's not to say that you have to use these expiration dates and strike prices, but these are really good starting points for you to start your research on any given outlook of a specific stock. Okay. So what we're going to do is we're going to go through an example here. We're going to go through an example from a trade a couple of days ago, which was an early breakout trade that was triggered one of our scans. It was C. For those of you that are not familiar, C is the Southeast Asian e-commerce site. There was a gaming website that's turned into one of the fastest growing e-commerce sites in Southeast Asia. You can think of it sort of like an Amazon type company based in Southeast Asia. They've been growing incredibly fast, and the stock has really kind of suffered a lot here over the last call it year or so. If you look at last September, this was a $200 stock. By March of this year, it was a $77 stock. So it shed more than 50% of its value over the last, call it better part of a year. And then over the last couple of months, the stock has stemmed the down move, has been trading sideways here for nearly 2.5, 3 months now. And just a couple of days ago, it started to break out here to the upside. And now this breakout here has started to pull back here a little bit. So our view is, what we have to monitor very closely is to see, does this now continue to move higher here, or does this just simply revert back into that trading range? If it reverts back into that trading range, we have to accept the fact that this didn't work out from a timing perspective, and we have to walk away. But right now, at the moment, it's still holding that 21-day moving average. We're looking for that upside here. The initial upside here is to our 110, which was our initial upside target. If we would get up to 110, that's really where things can really get interesting to the upside. So IV rank is relatively mild. It was in that 41% range today. It was actually a little bit lower when we entered this specific trade. There is no earnings coming up here, but the reason that we took a more directional view, and we took a directional view instead of using a long call, we used a long call vertical, was because earnings were just had just come out, meaning there's no catalyst on the horizon. Catalyst is usually the type of thing that can move a stock very quickly in a short period of time, but there's no catalyst coming up. So, while we have a strong directional view, that directional view does have somewhat of a limit, which, at the time our upside target was 110, which is why we believe using something like a debit structure like this makes sense as a starting point. Now, you can go out to July or you can use a shorter dated option here. We at the time chose to go for a slightly shorter dated option closer to 30 days because these types of breakout stocks, it's probably at least half of them fail as breakouts, but the ones that do work out, they work out very quickly. Meaning if it truly is a breakout, it will break out very quickly. And what was interesting for me was that this breakout here was on relatively high volume. We saw a high volume on this candle here, substantially high volume on that candle, high volume on the candle as well as there. So we just had three back-to-back days of really high volume here. So that gave me a little bit more confidence that this could move relatively quickly. And that's why, we use something like a debit trade structure here in this particular example, as opposed to selling options in this particular case. So, these are the things that we typically look at to gauge, what's the particular setup? What is the option market implying? Are there earnings coming up? What is the potential upside here from a support and resistance perspective? And those are the things that we look at to determine whether we want to be a buyer of options or a seller of options. A buyer of options when you do expect more of a strong directional move. A seller of an option is if you expect more of a modest underlying move for the underlying security. So that's just an example of a trade that we just made. I think it was yesterday's daily play, where it triggered 7 of the 8 ticks that we determined from last week. If you look at the filtering mechanism that we spoke about last week, 7 of 8 of them were met in this specific trade example of C, which was a early breakout stock that we identified. The time frame we were looking 4 to 6 weeks out because again, with these types of breakout stocks, they tend to happen very quickly. Volatility was fair; it wasn't particularly high at the time, so our view was that we could expect a big move, and that's why we used that debit call spread. And this is really where we want to use a structured approach to determine the trade structure. And keep in mind that you're not going to always get it right. I'll show you 2 examples where we recently got it wrong. When I say wrong, wrong is not the right term. Where we were suboptimal with regards to the expected move versus what actually happened. So AMD, this was a trade that we put on, I believe, in the middle of April. We sold the 250, 230 put spread at the time. This was, I think it was on April 15th. The stock was trading just above 250 at the time. And April 15th, yeah, it was trading at 256 at the time. We sold the 250, 230, I think, put spread here. And then within a couple of days later, the stock was already at 350. So this is an example where by selling the put spread, we sold a short put vertical as opposed to buying a long call vertical. We had more of a modest move expected because the stock had already run quite a bit before we got into the trade. It did have earnings coming up, but IV was also at pretty high at the time. So we chose that more modest move approach. and the stock ripped substantially higher here to our upper target within days. And we captured maybe about 15% of the move and missed out on about 85% of that move by using a short put vertical versus a long call vertical. Same thing here in Datadog. And Datadog was a trade that we made literally the day before earnings. I think that day was Datadog was on the 4th of May. So the 4th of May, it was right here. It had just made a new breakout here. It was just starting to break out here to the upside. It had earnings coming up. And to be perfectly honest, in hindsight, with earnings coming up, IV was relatively high, but because there was earnings coming up in a couple of days, this is one where, from at least from my perspective, it was probably worth taking the risk of being long premium rather than being short premium, given the fact that earnings was just coming up in a couple of days. And again, this is really one where by selling the short put vertical, we captured maybe just 15 to 20% of the move and missed out about 80 to 85% of the move because of using a short put vertical versus outright buying that long call vertical here. And there's been so many of these in the um, last couple of days, with CrowdStrike, with Datadog, with Dell, with Micron. We sold the 420-400 put spread on Micron at the time when it was at 420. It was at 450 when we sold the 420-440, and now it's an $800 stock, right? This was on 422. On 422, it was just starting to break out here. So that we had saw this call it the 450 level here as kind of a level, and when it broke out here above that level, we took a shot at a breakout trade. But at the time, the breakout was on relatively low volume. We weren't sure if this was going to be one that was going to really take off or fail. IV was relatively modest. There wasn't earnings on the calendar, so we took a short put vertical. So, this is a good example where, the expectation, given the data that we had, we still would have did the same trade, right? Like you can't always get it right. Ultimately you can't tell the future, so you never know what the future is going to look like. But this just gives you an example of, the difference between structuring the trade accordingly versus taking a suboptimal trade, and sometimes how much of the upside you could potentially miss out on. Which is why, on trades like this, when it does take off, we generally try to chase the trade, if you will, right? And we did that recently here with Oracle. We had that on 420, we sold the 170, 155 put vertical here on Oracle. This was 420. Yeah. So when the stock first broke out here above this 170, you see this resistance level that's automatically drawn on your chart. When we broke out above that level, we took that, we sold that for a 170, 150 put spread here. And then just a couple of days ago, on the 5th of May, when the stock was back up at, I'm losing on the 5th of May, when the stock was trading at 180. So it was a little bit higher than where it was, where it pulled back here and generated that buy signal here. We took another shot at selling that put vertical here. So this is a good example where, our views were correct. It pulled back here, it came back, and when it generated a new signal, even though our new trade has the initial trade that we made was profitable, but it wasn't necessarily at max profit. We want to kind of continue to press that specific trade because our view that this 170 level was going to hold has been confirmed. We continue to make a series of higher highs and higher lows, and as soon as we generated another signal, I think Oracle generated a buy signal here on the 5th of May, and that's when we entered that trade. or 5th of May was actually back here when it generated that new buy signal. That's when we entered again. And, a few days later, if it pulls back here again in this 190 level, we'll probably sell another put spread here. So, this is an example where when the trade moves in the direction you expect it to, if it gives you another buy signal a few days later or a couple of weeks later, take it. Don't just be happy with one winning trade. Just because you have a winning trade, especially if you have a winning trade, if it generates another buy signal, that's a great opportunity to size up because the market has proven your views to be correct, and that's how you can turn small wins into home runs. And that is really the difference between profitability and struggling with trading. Because probably the biggest lesson to learn from all of this is that you have to you have to take risk. You have to be able to take risk in the market. You have to take lots of risk in the market. And the only way to do that, consistently and not burn out is to do it in a structured way. And that's the structure that we're trying to embark on in this Stop Chasing Trades series. A structured way to evaluate ideas, a structured way to figure out what strategies to choose, a structured way to determine what size you trade on every single trade, so that the goal is to have a lot of trades out there so that you can continue to improve your trading by, you know, cutting your losers when it's not working out and pressing your winners when they do turn out to be correct. You know, it's been a really strong few weeks in the markets, right? I think any of you that's been long this market has had a good few weeks. But, times like this don't happen very often, and you really have to be able to press your winners in this time in order to be profitable. And at the same time, you have to be very structured in cutting your losses. And the reality of trading is that, the vast majority of trades that you make should end up either a small win or a small loss. And that's the vast majority of your trades. A small minority of your trades are the ones where you really hit a home run, and where you take a small winning trade, and once the market proves your view to be correct, you press that position and you start adding exposure, and you don't just add, and you try to add exponentially. You start with a 2% position. As soon as the market proves your view to be correct, move that up to a 5% position. And at least half of those will turn back into a small loss. And that's okay, because in a few of those positions, that 5% position will probably make up the vast majority of your gains for that specific year. A few small trades make the lion's share of your profits, as long as you can keep the rest of your trades to be small wins and small losses. And to do so, it just requires discipline. It's probably the discipline part, the mental clarity to do that day in and day out is what's so difficult and what makes this not easily achieved by most traders. But that's really where having a structure like the ones that we are showing you here during this specific series is designed to help you achieve exactly that.
Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and this is week 3 of our 3-part series on stop chasing trades, where we're going to be covering how to manage a trade towards profitability. Now, my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and this is the final part in a 3-part series called Stop Chasing Trades, designed to help you become a more disciplined and effective trader so that you can reach profitability. And today, what we're going to spend our time on is the management of the trade. The first couple of weeks we spent on selecting trade ideas, structuring the trade from a option strategy perspective. And today we're going to tackle the part that drains our emotional capital the most, which is What do we do once we are in a trade? Now, if you are new to options play, you can sign up for a free trial using the QR code on your screen or going to the link here on your screen, new.optionsplay.com/registration, which I will post into the chat window here. Um, and that will give you access to both the sessions from prior, the session one and session two, as well as you can get access to, we will be posting this as a single 3 hour session on YouTube so that you can watch the whole thing, the whole series at once. Once we finish today's session. So for everyone that may have missed the first or second session, we will be reposting this as a 3 part series. And if you sign up for your free trial at optionsplay.com, you'll be able to get access to that and the slides for today's session. So let's go ahead and get started and talk about sort of the problem that a lot of traders have, which is entering a trade is the easy part, but the P&L that comes from that specific trade is what makes us emotional. And emotions is really where we make some of our most counterproductive decisions towards profitability. If anyone has placed a trade, you're probably familiar with the roller coaster of emotions that you have probably gone through during the life cycle of a trade that goes from hope to greed to regret to panic to fear of missing out, depending on where in the stage you are within a specific trade. Now, like I said, the getting into a specific trade is not particularly emotional. It may be draining to find a specific trade, and that's one of the things that we covered in week one, is to have a filtering process that kind of reduces the mental drain from finding a specific trade idea of trying to decide, is this a trade that I should invest my specific capital into, and then making sure that you structure an options trade on the back of it. But once you're in a specific trade, that's really where the mental drain starts because every single P&L tick is another opportunity to think through, should I stay in the trade? Should I get out? Should I take profits? Should I cut losses? Should I hold on to it for longer? And every day you hold on to it, every minute that you're looking at the P&L of your position tick by, you are draining your mental capital. And I cannot speak enough how important your mental capital is because we all talk about financial capital, how to manage your risk in a portfolio, how to manage your specific portfolio. But what we don't talk about enough is your mental capital because when you are mentally drained, when you're emotionally drained, we don't make great decisions in that environment. So it's really important to have a process for deciding how you're going to spend your financial, but also your mental capital so that you can stay clear-headed and make the right trading decisions. So that's really what I want to spend the time here today covering because there are essentially 3 states to every single trade. You have a trade that's not going in the direction you expected to. You have a trade that is going in the direction you expected to. And then you have trades that effectively have stalled. They're kind of in that middle ground. And what we really want to talk about is the emotional trap that you fall into in each of these specific instances and the discipline that's required to monitor to effectively trade each specific position. So we'll talk about the ego trap that you fall into when a trade is not going in the direction you expected to, the conviction trap that you go into when the trade does go in the direction you expected to, and sort of the mental drain that you end up in when a trade has essentially stalled. And in each of these states, the rules that we come across, the rules that we instill are all designed not only to protect your financial capital, but more importantly, protect your mental capital. And this is and that's a resource that you have limited
resources for in terms of your mental capacity as much as your financial capacity. And it's really important that every single day you have the clarity and the mental strength to make the best possible decisions, because ultimately this is the biggest challenge that I think most investors face, is making the right decisions. Many times we know what the right decisions are, but we have trouble following through with that. And if you can relate to that, please type one into the chat window. If many times you feel that you know what the right decisions are, but when it comes to actually following through with them, that's where you struggle, right? And I've been a market strategist for 18 years. I have worked with thousands, tens of thousands of retail and institutional investors over that period of time. And that is probably the most consistent thing that I see across the board with traders, is the struggle that we have as human beings in following through with the trade plan. We have a trade plan, but we have trouble following through with that trade plan. Some of us don't even have a trade plan either. So, what we really want to do today is to make sure that we instill a trade plan, but more importantly, walk through how you can potentially follow through with that trade plan, but more importantly. So, the first thing that we really need to address is what happens when the trade is not going in the direction that you expect it to. You buy a stock, buy a call, buy a bull call spread, whatever it is, and the stock drops. And we fall into this trap. Well, if we can just hold on to this one more day, maybe it will come back. And when a trade doesn't go in the direction we expect to, instead of accepting that, instead of cutting losses, we come up with all types of excuses to stay in the trade just one more day. Maybe if we just hold on to it for one more day, it'll come back, right? And I think most of us are, can understand when we're guilty of this, when we buy a stock because it crossed above the 200-day moving average, the stock doesn't go in the direction we expect it to, and now we start looking at other indicators, hoping that some new indicator will tell us now is the right time to be buying it. And the reality is, the reason that you got into it is no longer the reason that you're staying in it. You're just trying to find any justification to stay in this particular trade. Why do we do this? Because cutting losses means admitting that you are wrong. And the admission to this inability to admit that you're wrong is why a lot of traders hold on to a trade far longer than they really should. And here's the thing, is that the reality of trading, that most education, most strategists, most subscription services that are trying to sell you something don't tell you about, is the fact that even some of the best traders are probably seeing somewhere in the vicinity of at least 40, maybe even 50% of their trades resulting in losers. And there's really no other profession, no other part of your personal life where you can say, I'm wrong 30, 40% of the time, but I'm really good at doing what I'm doing, right? Could you imagine that if you were at work and you were just flat out wrong 40% of the time of whatever it is that you do at work, but you're really good at your job? There's really not many other parts of our world where you're wrong that often and still considered good at what you do. But that's the reality of trading. That at least 30 to 40% of your trades will likely result in a losing trade. And the sooner we can get comfortable with that, the sooner we can realize that and accept that, the better you're going to be in the long run as a trader. Does that make sense, everyone? Someone mentioned best loser wins. And that's probably, I would argue, one of the better books written on this specific concept. And the evidence is pretty clear. There's a ton of empirical evidence, whether you look at evidence from what data that gamblers, tell themselves, or there's quite a bit of evidence that, we feel losses twice as painful as the equivalent gain feels good. Um, and holding losers is far more expensive than it looks. Every day you hold on to a losing position is a day that you're not in a winning position. And that opportunity cost compounds quietly. And this is probably one of the biggest challenges that we have. However, this is actually the one rule that is completely non-negotiable, which means that this is actually the rule that should take the least amount of mental capital. Because if a trade is not going in the direction you expect it to and has triggered effectively what is a stop loss level, this should be the easiest decision of your day because it's black and white. There's no ifs, there's no buts. Either the stock has triggered your stop loss rule or it hasn't. And if it has triggered your stop loss rule, you close it, non-negotiable, you move on, and that's it. Because if you size your trades appropriately, which is something we talked about last week, and a stop has and a trade has triggered its stop loss, you have now expended maybe 1% of your total portfolio. You should have 99% of your portfolio left to trade another day. This should not be an emotional decision. This should only be an easy, quick decision that you can do at the beginning of your day. Get that cleared off your desk and focus on harder decisions that you have to make, which we'll talk about next. But the premise of this is that you size the trade appropriately to begin with. If, let's say, you size your trade incorrectly and you've risked 5%, 10%, maybe even more of your account, that's where this part is not easy to make, right? Because once you've risked 5% of your account, to accept that loss, it is much, much more painful than accepting a loss where you're losing 1% of your account. And that's a decision that you made at trade entry that's going to hurt you at trade exit. And this is why sizing your trades appropriately at the very beginning is incredibly important. Does that make sense, everyone? Please type one into the chat window if that makes sense to you. Because sizing, in order to stick to a decision here where you are able to follow through with this rule and not make it emotional, you have to size your trades appropriately to begin with. If you've traded too big of a size, and unfortunately, the only person you can blame is yourself when a trade is sized incorrectly, right? A lot of people will say, um, I followed some kind of a subscription service, or I followed someone else who told me to do something. The trade turned out to be, a bad trade. I lost a ton of money. And what did they do? They try to blame the subscription service or, who told them to get into that trade. But I always say, the subscription service or the whoever told you how to trade didn't force you to trade 5% of your account or 10% of your account. You did that. You have to, the sooner you can admit that you are the true problem here, the faster you will graduate and become a better trader. But if you keep blaming someone else for the bad trade idea when you're the one who traded too big of a size, then you're blaming the wrong thing and you're going to continue this cycle over and over again. No matter who you subscribe to, no matter who you follow, no matter what strategy you trade, you will always end up in the same trap if you size your trades incorrectly. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you, because um, what I'm explaining to you today is only applicable if you can size your trades appropriately to begin with. Okay? So, some of the numbers that we've seen over the years is that retail traders will typically sell their winners 50% more often than their losers and hold losers 20% longer than their winners. Um, and this is because of the fact that we feel losers to be twice as painful, meaning if you lost $1,000, you perceive that to be twice as painful than if you were to gain $1,000 on a specific trade. And we have a really tough time accepting the fact that we are wrong on a specific trade. But again, I point you back to the fact that, the best traders are wrong 30, 40% of the time. And it's really just hard to even imagine anything else in your life where you could be wrong 30, 40% of the time and considered to be the top of your game. And that's really why we have such a tough time accepting losses as a trader, because there's just no other part of our life where we can be wrong 30, 40% of the time and be perfectly comfortable doing that. But that's the reality of trading. And the faster you can adapt to that, the faster you can start moving forward in your progression towards profitability. Okay. The second part, the second state that we want to talk about is taking profits. And this is the conviction trap, because hitting your target is many times seen as a signal to exit, right? And 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 I think most of us can relate to this, where a trade that we have made is profitable, and you tell yourself, I should lock this in before it goes back down. That is probably one of the most common feelings that we have on a winning trade, because we perceive a trade that is currently a winner, if it turns back into a loser, we feel incredibly painful than if that was just a trade that was a loser to begin with, right? A trade that was originally a win that turns back into a loss is incredibly painful for us to go through. And because it's incredibly painful, we tell ourselves, I should lock this in before it goes back down. And there are so many, I would actually, I take that back. There are many instances where books have been written on this specific topic. Traders have talked about this specific topic, but it's just a particular topic that's not sexy and that a lot of people don't really want to spend the time to learn. But the most famous book ever written is from Jesse Livermore. Most of us that have read kind of any finance books have read Reminiscence of a Stock Operator. It's a much older book, but it is probably the one book that originally taught us this specific concept, which, he wrote, it was never my thinking that made me big money. For me, it was always my sitting, meaning it was my ability to let a particular trade run rather than sitting and rather than thinking through it and trying to decide when is the right time to exit. And this couldn't be more true because and I'll talk about this here, some of the stats here in a few minutes, but cutting winners short is the number one cause for underperformance. And it's not hard to realize or understand why we cut our winners short because of um, having a winning trade turn back into a loser is incredibly painful. And to avoid that pain, what we do is we try to take profits whenever we can. And we tell ourselves, you can't go broke taking profits, right? That's a term that a lot of people have adapted or adopted over the years. But I can tell you, taking profits early is the number one reason that portfolios cannot reach profitability. Because when you have 30 to 40% of your losers trades end up being losers, you need to have big winners to offset your losers. And the only way to have big winners is to do the exact opposite of what your gut tells you to do. Your gut tells you I should lock it in before it goes back down. But if you look at any profitable account in the long run, what they do with a profitable trade is they don't take profits. They add to that exposure. Which is, I think, probably one of the hardest lessons to learn in trading. But once you can get past that learning process, once you can start flexing that muscle of when you have a winning trade, don't take profits, add more exposure in that winning trade, that is what's going to transform your trading in the long run. And, I try to instill this practice in the daily plays that I post every single day. And I'm just trying to give you some examples of this because if you look at Rocket Lab, we just entered another Rocket Lab trade yesterday. We had a Rocket Lab trade from May 19th, and then we had a Rocket Lab trade from May 11th. So we entered Rocket Lab, the first one, on May 11th when it was at 105. And then by May 19th, the stock was up to 131. It generated another buy signal, so we entered another bullish trade in Rocket Lab. And just yesterday, it generated another buy signal, and at 143. So that is an example of how to add to a position when you are profitable, as opposed to just simply taking your profits and running with it. We did the same thing with applied materials. We entered a trade in applied materials on May 21st, but we already had two positions in applied materials prior to that. We had one from April 17th, and I think we had another one. Um, Maybe applied materials. Yeah, so we had one on April 17th when applied materials was at 389. And then when applied materials generated another buy signal on, let's say, what did I say, 519? 521, when it was at 426, we entered another bullish trade, right? We did the same thing with Dell. We entered a trade on Dell on April 29th, and then we entered it again on May 13th. And there's plenty of examples of this, excuse me, that I can pull up on. We also have we had one on Alphabet when it was at 336. We entered again on when it was 349, and then I think we had yeah, so there was two trades here on Alphabet. So what I'm trying to say here is that I'm trying to, or I am implementing these specific rules that I'm teaching you in the daily plays, and I'm calling them out as I do them in the daily plays. So if you look at the Rocket Lab trade um, um, yesterday, if you look at the write-up, I specify, we have two winning trades already in Rocket Lab, and here's an opportunity to add further to this position to try to hit that home run. And this is really where, if you look at trades like this, I'm calling out the trades, but I'm also helping you understand the thought process behind why we are adding to a winning position. And instead of scaling those positions and reducing exposure when the trade is going in a direction, we want to add exposure. And like I said, arguably, this is the hardest lesson to learn because it goes against every single grain of your fiber that tells you to take profits and run as opposed to adding exposure. But once you can flex that muscle, once you can turn a winning trade to adding exposure into your muscle memory, that is one of the things that will transform your portfolio in the long run. And I'll talk about the statistics around this here in a second because I think once you kind of look at the statistics, that's when you're going to realize, why this stuff is sometimes hard to do initially when you first learn it. I think a lot of traders, when they first learn this concept of adding to a winning position, and many times it takes traders weeks, months, sometimes even years to really finally pull the trigger on it because they understand it, but mentally it's really hard um, to follow through because we second guess ourselves every single time we have a winner. We say, let's take some profits. You can't go broke taking profits, but you can underperform severely as a trader when you take profits too early. And the last state
that we find ourselves in is when a trade is kind of stalled. And this is the capital trap, the mental capital trap, because this is when a trade has not triggered a stop loss, it has not hit our targets, and this is really hard to judge. What do we do, right? Like it's just not working exactly the way we expect it to, but it hasn't triggered our stop loss. So theoretically, we could just keep holding on to it. And for many people, that's what they do. But this is really where I encourage traders to recognize early on when a trade is not going in the direction you expect it to. I would say an example of this is probably, let's say, um, well, what's an example of a trade that we recently made that I think is has not gone the direction we expected to, but also hasn't really hit our stop loss. So we entered a position in C on May 13th, um, when it was at 96. And the stock is kind of initially what we were looking for is this potential breakout here, right? We said, the stock was basing, looks like it's starting to break out here, and it broke out on some high volume as well. And then it kind of just pulled back here and it's been trading sideways here, right? Still above that 26-day moving average. It's still theoretically trending higher here. As you can see, the trend quality continues to be decent, right? It hasn't taken off here, but it's got everything that in terms of what we're looking for now. This is if you look at the position here on May 13th, we bought the 97.5 115. So we bought a call spread. So this is really where I say, what you want to look at is the trade, if whether or not you're a long premium or you're short premium. Because if you're long premium, time is working against you. And that's the trade that we're in right now here in C, is that we're long premium. Time is working against us. Theta is working against us and bleeding on this trade every single day. And if the stock is stalled, that premium is going to just continue to erode the trade. And this is really where we need to be more disciplined in how we evaluate trades on an active basis, because if a trade is working against you and is when you have a long premium trade, the disciplined response here is to cut and reallocate and move your capital to a better setup. However, if let's say you're short premium and time is your friend, you have a little bit more wiggle room because you can hold on to this and see if your thesis and give your thesis a little bit more time to play out, because time is working in your favor. Time decay is working, is adding to your P&L, but it still requires you to review why you got into the trade, whether or not the trade that you got into is still valid or not, because that is a different skill set in terms of being able to reference back to why you got into a trade and follow that logic through as to whether or not that reason is still valid. A lot of times what we do is, by the time we're trying to evaluate whether we are in the trade, we have completely forgotten why we got into that trade to begin with. And if you don't remember why you got into the trade to begin with, then you can't really answer the question, is this trade setup still valid? And that this is really where taking notes, if you need to, is incredibly helpful so that you can reference back, why did you get into this trade? We got into the trade because it broke out above that resistance level. It broke out above that resistance level on high volume, and we were looking for that quick move here to the upside, right? And I would say this fact that it's trading sideways here, it hasn't really broken some prior support here, so it's hard to say that this is no longer valid. But this trade is not working in our favor because time is working against us. So this is a good example where the trade has not triggered our stop loss, but things are stalled. Things have not worked out that we expected to. This is an example where it's probably better to close out this particular trade, whatever capital we can save in this particular trade, reallocate it to something that is moving, like
The Airbnb, like the GE trade or the App Lovin trade from earlier today. Looking at trades like this that are taking off, that's where we want to reallocate our capital to on stocks that are starting to take off here, like the one that we put on a daily play today. It's better for me to reallocate that C trade into something like App Lovin because that's really where I have a much higher probability of potentially making money on this trade than holding on to a trade that is effectively stalled. Does that make sense, everyone? Please type two into the chat window if that makes sense to you. And the we don't talk about this enough, but trades that have stalled take up a significant amount of mental capital because this is, because there's no rules for this particular setup, right? And where there's a lack of rules, we tend to just go around in circles, driving ourselves crazy, trying to figure out what to do. Um, and this is really where we want to start instilling the concept of having rules when trades aren't going the direction you expect it to, depending on whether you're a long or short premium, and then building that muscle memory of being able to validate a trade based on the original thesis of why you got in. That requires you to remember why you got in. That requires you to be able to be objective on whether or not that thesis is still correct. And if it is, stay in the trade, meaning have the conviction to stay in the trade if that thesis is still correct. But if the thesis is no longer true, have the conviction to close out the trade even though it has not triggered your stop loss. Okay. So why do we do this? What I want to do is I want to start talking about some of the statistics. Because the reality is, if you and I pulled these trades from our daily play trades just to give you a sense for, what the reality of trading is. Because a lot of people think that, oh, if I just, follow all these rules or, what all these different, people are teaching me or the different strategies that are out there, if I just follow, what they tell me do exactly, I'll make, 80% of my trades will be winners and I will be profitable. And that just unfortunately couldn't be further from the truth. Just trading doesn't work that way. Like I said, most traders will have somewhere between at least 30 to 40% of their trades to be losers. And and mentally, that's just really hard to wrap your head around how you can be good at something but wrong 30 to 40% of the time. And if you look at the daily plays, 40% of our trades, 39% of our trades ended up being losers. That's okay. 29% of our trades ended up being, what we call standalone wins, which are effectively small wins, right? So look at that. That's 70% of all our trades, basically end up in a wash. Small wins, small losers, they don't really go anywhere, when you combine the two together. But 32% of the trades are the ones that we added to. Now, 32% doesn't mean that 32% of our trades were winners and we added to them, but just that when you consider the trades that you added to, they make up roughly 32% of the total exposure that we have on a trade, on all the trades that we make. So meaning really it's maybe about 15% of the trades that are winners that we add to. And because we add to them, they take up a larger percentage of our portfolio, right? And as you can see, even though only 32% of the trades were the ones only about 15% of the trades were winners that we ended up adding to, those 32% of those ultimate exposure that we have accounted for 55% of the total profits that we have in the account. The standalone wins accounted for 45%, and the 32% accounted for 55% of our winners. So what you realize in the long run is that a small percentage of the trades is really what generates the lion's share of the profits in that particular account. And that in order for you to be profitable, you have to make sure that the losers here stay small. And the way to keep losers small is
actually incredibly simple. There's two parts to it. Number one, you size your trades accordingly or appropriately when you get into the trade, and you cut your losers when you're supposed to cut them. If you can follow those two rules, the first part will stay small. The small winners will always be there. They're just part of trading, the same way small losers are part of trading. But the third part, in order to have this big box here on the right that generates the real profits in your account, what you have to do is have the fortitude to be able to add to your winning trades. Like I said, it's only about 10 to 15% of your trades will result in, a trade that ends up being home runs. But in order for those home runs to materialize, you have to be able to add to winning positions, not cut your winning positions short. Otherwise, you're just going to end up with a bunch of small losses, and you will have a bunch of small wins, a bunch of small losses, and a portfolio that essentially is either net zero or maybe even a net small loss because of all the transactions that you are making and the transaction cost of that specific account. Does that make sense, everyone? Please type one into the chat window if that makes sense to you. So, if you look at kind of the results, right, and these are some of the stats from our daily plays. If for every $1 we lost, we made $1.44 in our daily play. The win rate ended up being about 55, call it 56%, right? So if you look at the total loss, total trades that ended up being losers, about 44% of them were losers. And that's really kind of the reality of trading. It's really hard for a lot of traders to kind of wrap their heads around being wrong or having a loss on 44% of their trades. But when you look at the hit rate of trades that were profitable that we added to versus kind of the one and dones, 72% of the trades that we added to ended up being winners versus the one and dones were about 50%. Um, and like I said, 32% of the trades ended up accounting for 55% of our total profit in these specific trades. Some examples of this are we've done this in Micron, where we had an original trade, we added to that trade 3 times. We had an Alphabet trade that we added to it 3 times. And we have a Caterpillar trade that we added to 1 time, press it on the breakout. So this is really where the stats, like I said, even if you follow all these rules, the stats may not sound that compelling. A lot of people somehow think that if you just follow all these rules, if you follow kind of the best traders, you'll be winning 80, 90% of the time. That's just not reality. And that the sooner you can realize what reality looks like, the faster you can start really adapting your mental capital or the way that you think about how you handle winners and losers differently. Because if your perception is just that, oh, if I just get better at trading, if I just learn all these things, I'll be right 80, 90% of the time, then I unfortunately, feel that you will always be caught in this particular trap over and over again of never reaching profitability just because your perception of reality was never realistic, and unfortunately for those reasons you never end up hitting that reality. But if you can kind of reframe what reality looks like, that's when you have the opportunity of really accepting um, losses when they come with as easy as possible, and really spend your time as much as possible on the few winning trades that you do have that are running, right? Like I said, we happen to be in a market right now where you have quite a few technology stocks, AI stocks that are just continue to run and run and run. And if you didn't have the fortitude to press winners, you would have gotten out of most of those trades probably a few weeks ago and missed out on most of the gains, right? And if any of you can relate to that, right? How many of you bought Micron at 300 and got out at 400 or 500 and missed out on the rest of the move?
How many of you have missed out on the moves for a lot of these stocks over the last few weeks? Just think about that for a second. Um, and if you are one of those traders that, maybe caught on the initial move and did not, and, took profits too early, that's a really good opportunity to go back and think through what was my feeling? What was I thinking when I sold out of Micron at 4, 5, 600 bucks? Was it because I was panicked that if I didn't, maybe Micron would go back down to 300, and I didn't want to have that particular position, right? I already felt lucky enough that I caught that move from 300 to 500. It's perfectly reasonable to think like that. But if you kind of look back and think through, if only I had added to that position, my portfolio would look very different today than it does. That's really where, you start transforming yourself as a trader. And that's what I've been trying to do in the daily play portfolio over the last few weeks, is in all of these AI stocks that we were initially caught on, instead of just taking profits, we kept adding to these positions. Marvell, AMD, Applied Materials, Rocket Lab, these types of stocks. What we're trying to do is show you a pattern of how to actually do it in the daily play so that it becomes a muscle memory. With that, just to kind of recap what we learned here today, you have three rules that are essentially set when you enter the specific trade. And what you're trying to develop is the mental capital to follow through on each of these decisions. Stop loss. Where am I wrong? When they trigger, follow through. I think the best practice is that the first thing you do in the morning is you go through all the trades that have potentially triggered a stop loss that morning and just clear those out of the decks. Get those out of your get those out of the way and protect your mental capital, because when a trade is going in your favor, that's going to take a lot more of your mental capital to really, research which winning trades are the ones that you want to add to. That's going to take some mental capacity to do. And the more clear-headed you are when you start looking at the trades that you are profitable on, the better you are likely going to be make trading decisions on. And then lastly, you look at kind of the ones where the trades have stalled, because the trades that have stalled are not as urgent as the ones where, you have the opportunity to add to a position. And that's really where the order of operation that I usually take every single morning is: get rid of all the trades that have triggered a stop loss first thing in the morning, get those out of your hair, then focus really most of your attention on your winning positions. That's really where you want to spend the bulk of your time. And then once you've gotten through all of those, then you can look at your stalled positions and see which ones perhaps you might want to cut and reallocate towards winning positions or new positions at that stage. And only after you've done these three do you then look at new opportunities for the day. So always protect your exposure in the markets first. Get rid of your losing trades. Look at when your winning trades require, adding to or cutting, and then only after you do that do you then look at brand new opportunities in the market. So that covers what I wanted to share with you here today. Like I said, if you're brand new here to Options Play, you can sign up for, access to our tool and the daily plays that we send out every single day that helps you follow through on these specific rules that I'm teaching you here at new.optionsplay.com/registration, or you can point your phone to that QR code. I will put this link here in the chat window for anyone who wants to, if you are new to Options Play and you want to sign up. But like I said, this is the third part of a three-part series, um, of what we call stop chasing trades, because
we make decisions that are not particularly helpful towards profitability from when we enter the trade, when we're looking at ideas, right? How do we decide which ideas are worth our capital, which ones are not? How much to like allocate to a specific trade? How do we match the structure, the option structure to the thesis? And then more importantly, how do we manage each trade depending on whether it's going in our favor or against us? So this is a three-part series. What we will be doing after today is we will be taking all three sessions, stitching it into one long course that you can watch, and we'll send that out to everyone, including the slides from all three sessions. And that will be available to anyone who is a member here at OptionsPlay. So sign up for that at new.optionsplay.com/registration. And it is probably the single most important process that you can build if your goal is to reach profitability. I'm sure everyone who's watching this is either trying to reach profitability or struggling to reach profitability right now. Um, and for those of you that have been following us for years, I hope that many of you that have been following us for years have been learning this and continuing to build your muscle memory on doing these specific rules that we walked over here today, and on your path currently to profitability.